Have you ever wondered why some countries seem to have complete control over their interest rates and inflation, while others appear to be constrained by global financial forces? It is a fascinating puzzle at the heart of international economics. The fundamental trade-off for domestic monetary policy autonomy lies in the concept known as the Impossible Trinity, or sometimes called the trilemma. In simple terms, a country can only choose two out of three desirable policy goals: a fixed exchange rate, free capital movement, and an independent monetary policy. You simply cannot have all three simultaneously. This limitation arises because these three objectives are inherently interconnected and often pull in different directions. For instance, if a country wants both free capital flows and a fixed exchange rate, its central bank loses the ability to set interest rates independently because it must use its monetary policy to maintain the peg. Conversely, if it prioritizes independent monetary policy and free capital movement, its exchange rate must float freely to absorb external shocks. So, how do countries navigate this trilemma? They must consciously choose which two objectives are most important to their economic strategy. A nation might opt for an independent monetary policy and free capital movement, allowing its currency to float. This grants the central bank flexibility to manage inflation and stimulate growth, but it exposes the economy to exchange rate volatility, which can impact trade and investment. Another choice could be to fix the exchange rate and allow free capital movement. This provides exchange rate stability, which is great for international trade and investment, but it means sacrificing independent monetary policy. The central bank must then adjust interest rates to defend the fixed rate, even if those rates are not ideal for domestic economic conditions. Think of how Hong Kong maintains its currency board, closely tying its monetary policy to that of the United States dollar. Finally, a country might choose to have a fixed exchange rate and an independent monetary policy. To achieve this, it must impose capital controls, restricting the flow of money in and out of the country. This allows the central bank to manage domestic interest rates and stabilize the currency, but it can hinder international investment and potentially lead to inefficiencies in financial markets. China, for example, has historically used capital controls to manage its currency and monetary policy. Understanding the Impossible Trinity empowers you to analyze why different nations adopt specific exchange rate regimes and why their central banks make certain decisions. This framework reveals that every choice in global finance involves a strategic give and take, balancing domestic priorities with the realities of an interconnected world economy.